When people first hear the word HSA or health savings account, they typically first associate it with paying off medical expenses. However, what if I tell you it's actually one of the best retirement investment vehicles out there, much better than the Roth IRAs or the 401ks? Would you believe me? As a matter of fact, in one of Dave Ramsey's video, he has talked about he's accumulated over $150,000.
I've got almost $150,000 in this stupid thing because I've never used it. It's become one of the few tax-free things I can still do because of my income being high. So it's a cool. I'm a big fan of the HSA.
So in this video, I'm going to talk about 6 mistakes when it comes to HSA, and these 6 mistakes are the things that people often overlook until it's too late, I myself included. So I really want to share my learning with you guys so you can avoid making them. And by doing so, you can easily save hundreds of thousands of dollars and achieve financial independence early. Because after all, who doesn't want to be lying on their favorite beach, staying at some 5-star hotel, and not have to worry about money when it comes to retirement? So what is the HSA? HSA is a health savings account that typically comes with a high deductible health plan, which allows for a lower insurance premium in exchange for a high deductible. If you've been following my channel, I am a big fan of HSA because it's known as a triple tax advantage account, where the money goes in tax-free and the investment grows tax-free. And finally, the money comes out is also tax-free. HSA is also great, especially when you are anticipating a large medical bill coming your way in the near future. In my case, labor and delivery is extremely expensive in the places I live in California. Having a high deductible plan actually allows me to max out that deductible and not have to pay any extra money once that deductible has been met. Even though HSA is traditionally known as a way to pay off medical expenses, you can actually withdraw the money for other use penalty-free after you turn age 65. You only have to pay ordinary income tax on it. But if you do decide to withdraw early, there's a 20% tax penalty on top of the ordinary tax you have to pay. So my employer offers HSA under the provider health equity. So I'm going to use health equity as an example for this video, but feel free to apply the same techniques with your own HSA providers such as HSA Bank, Optimum Bank, etc. Mistake number 1 is to pay off your medical expenses directly using a HSA debit card such as this one. Instead, you want to be using your personal credit card to pay them upfront and reimburse it later through the HSA portal so that you can gain credit card rewards. I like to use it especially when I'm hunting for credit card intro bonuses, but hold on a second.
Stop it.
Before you proceed further on submitting your receipts, there's actually another mistake which I'll talk about in just a second that I think you should avoid. And the second mistake is not invest all the money in your HSA. So as soon as you make contribution to your HSA account, the first thing you need to do is to turn on automatic investing. Here I've enabled it while still keeping $500 in cash just for any emergencies. Here I chose 2 Vanguard funds, the Vanguard Growth Index Institutional and then the Vanguard Institutional Index Plus. I purposely picked a fund that has higher return but also with a higher variance because I'm still young in my retirement age. And please comment down below if you want to see a more step-by-step tutorial on exactly how to invest in HSA. I'll consider making one if enough people are interested. So the third mistake is the mistake that I was talking about earlier. That is to pay off your medical bill immediately after they incur. Unlike FSA, HSA actually has no time constraint on when you have to submit your reimbursements. The RIS states that as long as your qualified medical expenses were incurred after your HSA was established, then those expenses will be eligible. I actually didn't know that initially, and after I found out there's no time limit, I stopped paying all my medical expenses through HSA. Instead, I kept my money and invest them. And with that said, you want to keep a record of all the medical bills for yourself, your spouses, and your dependents, because all 3 people are eligible to be covered under your HSA, even if they are not on the same medical plan. The reason you want to delay on incurring these expenses is you want to have a larger initial investment so all the money can compound over time for the longest time possible. So let's compare 2 scenarios. Scenario 1, you decide to delay your payments 20 years later, whereas scenario 2, you pay right away. So your annual contribution, let's assume you max it out at $3,600 per year. In scenario 2, your annual contribution is $15,000 per year, assuming a $2,100 spend on your medical expenses. And plugging these numbers into the compounding calculator, over 20 years, the future value of my scenario 1 is $158,000 compared to only $66,000 in my scenario 2. And by deducting my expenses, which is $2,100 over 20 years, a net of $116K, it's a whopping $50,000 difference. This is only assuming a conservative year-over-year growth at 7%. But if you're looking at my current HSA account, my annual growth is around 31%. And this is also not taking into account the catch-up contribution you can do, which is around $1,000 once you turn age 55. If you like this video so far, I would really appreciate if you hit that like button because it really helps me out with the YouTube algorithm. With that said, I'm actually gonna give you 2 bonus tips I'll talk about towards the end of the video, so make sure you don't miss them out. On to the next mistake. The next mistake is not to max out your HSA. This might be an obvious one, but keep in mind that the HSA contribution limit actually increases year over year. As of 2021, the contribution limit is at $3,600 for individuals and $7,200 for family. My general rule of thumb is anything that has a limit for a reason. For example, Costco will limit 2 quantities of toilet paper per person only when COVID hits for a good reason, so you should definitely max it out. And for some reason you forgot to max out your HSA for the previous year, 2020, it's still not too late to do so because the deadline is actually the tax filing deadline, which is April 15th this year. You can do that by go to your HSA portal, click on My Accounts, HSA, and make a one-time contribution from an external account. Just keep in mind that this is after-tax money as opposed to if the HSA come off of your paycheck, which is pre-tax, but you can actually deduct it when filing tax. And be sure not to exceed the RS limit, which is $3,600 for 2021 and $3,550 for 2020, because if you do exceed, there is a penalty. Something to watch out for is if you made a mid-year election change, you want to be careful when it comes down to calculating the maximum contribution limit. For example, if you have individual coverage for the first 5 months of 2020 and change to a family plan for the remainder of the year, your total contribution amount is no longer $7,100, it's actually $5,626 based on the below calculation. So 5 months over $3,550, the individual limit, and 7 months for the $7,100, which is the family limit. And don't forget, if applicable, you need to include both the 1099 SA and the 5498 SA when it comes to tax filing. And the next mistake is not transferring all your funds from your previous HSA when you switch employer. This one, I learned my hard lesson because HSA administrators such as House Equity and similar applies to other providers as well, charges $2.95 once your balance is below $2,000. This threshold actually varies across different providers, and this wouldn't be an issue if you're with an employer because they usually covers the administration fee. So if you do have an existing HSA with a previous employer, make sure you initiate a custodian rollover from your old account to your current HSA account. This not only helps you to avoid the monthly fee I was talking about, it also helps you to consolidate your funds so you have one place to manage all your HSA investment. And the final mistake is to own both the HSA and the FSA at the same time. This wouldn't be an issue if you're single because your employer wouldn't allow you to do so. However, this would become an issue if your spouse also owns the FSA plan. This is exactly what happened to us because I myself own an HSA through my current employer, and my husband also signed up for his own FSA without my knowledge. So to fix that, we had to actually terminate his FSA mid-year through a life-changing event. Hopefully that addressed the issue, but make sure to update you guys if there is a tax consequence. The big lesson here is always communicate with your partner when it comes to tax savings or retirement accounts because you never know whether there's any type of interference. An exception here would be if your spouse owns a limited purpose FSA or LPFSA, which covers medical and vision expenses only. Alright guys, 2 more bonus tips as I've promised earlier. The first one is front loading. So instead of taking a fixed amount of money out of your each paycheck, you can actually do a one-time contribution by click on add contribution, customer amount, and put the amount of dollars you can deduct for which paycheck. And the second tip is to go over the HSA eligible list once again, because you'll actually be surprised to find out there are quite a lot of HSA eligible categories that you don't typically think of. For example, I did a body fat percentage measurements about 2 years ago. It's called body spec, and that one was also reimbursable. If you found my video helpful, please consider liking my video and subscribe to my channel. Thanks so much guys. If you're interested in other FIRE related content, I've also curated a personalized playlist right here. Be sure to check them out as well. Hope to see you guys soon in the next one. Bye.